We need to talk about the Dow Jones. You know, the world's most famous, most quoted stock market index. We see its number on the news every single night. But what if I told you the whole thing is running on an engine designed back in 1896, and for the modern world, it's completely, utterly broken?
It all really comes down to a simple question. Who do you think has more pull in the stock market? A tech giant that's one of the most valuable companies on the entire planet, or a health insurance company? The answer seems pretty obvious, doesn't it? Well, get ready, because what you think you know is about to be turned completely upside down.
So on one side, you've got Apple. I mean, it's a name everybody knows, a company whose total value, its market cap, is measured in trillions of dollars. And on the other side, we have United Health. Now, don't get me wrong, it's a huge, very successful company, but its total economic footprint, it's just a fraction of Apple's. We're talking 4 to 5 times smaller.
And this is the crazy part. In the Dow Jones Industrial Average, that smaller company, United Health, has way more power. How is that even possible? Well, that's the puzzle we're going to solve right now.
This right here is the Dow's bizarre central paradox. It's an index that, believe it or not, doesn't actually care how much a company is worth. All it cares about is the sticker price of a single share of stock. And that one simple fact creates some truly mind-bending results.
To really get why, we have to jump in a time machine and go all the way back to 1896. See, a guy named Charles Dow needed a simple way to get a snapshot of the market. He didn't have computers or Excel spreadsheets, so he came up with a beautifully simple idea. Just add up the stock prices and divide. What was a really smart, elegant solution back then is frankly a structural catastrophe today.
And this is where you can see the difference clear as day. The S&P 500, which is what pretty much everyone uses as the modern standard, is market cap weighted. That just means a company's influence is based on its total value. Makes sense, right? The biggest companies have the biggest impact. The Dow, though, is price weighted. A company's influence is based only on its share price. So what happens? The companies with the highest sticker prices call all the shots, no matter how big they actually are.
And here is the absolutely absurd result of that system. Just because United Health's share price happens to be about 3 times higher than Apple's, it gets 3 times the voting power in the index. You can see it right here on the chart. A health insurer's daily stock movement matters more to the Dow than the ups and downs of one of the biggest companies in the world. It's wild.
But listen, this isn't just some quirky math problem for finance nerds. This broken system has real consequences. It creates this bizarre world where companies actually get punished for doing something good for their investors, like making their shares more affordable.
Just look at what happened with Apple stock split back in 2020. A stock split doesn't change a thing about the company's value. It's like swapping a $200 bill for $200. You still have the exact same amount of money. But for the Dow, this was a disaster, a mathematical execution. Apple cut its share price into 4 pieces, and poof, instantly its influence in the world's most famous index got slashed by 75%. It literally got punished for making its stock easier for regular people to buy.
And what this really means is that the Dow literally can't handle America's biggest success stories. I mean, could you imagine if they added Berkshire Hathaway with its stock price of over $600,000 a share? The other 29 companies would basically become irrelevant. The index would just be the Berkshire Hathaway tracker. And for years, huge companies like Amazon and Google were kept out for the same reason. Their prices were just too high for the Dow's 19th century math to deal with.
Okay, so this brings us to the next big mystery. We always hear these giant numbers on TV. The Dow is up over 38,000. Where in the world does that massive number even come from? Well, it's all part of the index's grand illusion. There it is, that huge number we all recognize. It feels so important, right? Like it's a true measure of the market's power. But its enormous size is actually kind of a magic trick. Because, get this, if you actually add up the share prices of all 30 companies in the Dow right now, you get a number that's somewhere around $5,000 or $6,000. So how on earth do you get from 5,000 all the way to over 38,000?
The answer is a little piece of mathematical wizardry called the Dow Divisor. You can think of it as the ghost in the machine. Every single time a company splits its stock, or a new company gets added or removed, they tweak this number to keep the index's final value looking consistent over history. And after more than a century of these little tweaks, it's now a teeny tiny fraction.
And here's why that matters so much. Because you're dividing the sum of those stock prices by this tiny little number, it creates a huge multiplier effect. Right now, for every single $1 change in just one company's stock price, the Dow index moves about 6.6 points. So when you hear on the news, the Dow dropped 100 points, it sounds terrifying, right? But it really just means that across all 30 stocks, their prices collectively fell by about $15.
Which, of course, leads us to the final and maybe the most important question of all. If the Dow is this mathematical dinosaur, this relic that distorts reality and punishes success, why is it still everywhere? Why is it on the news every single night? Why does it endure?
Well, there are pretty much three big reasons. First, it's famous. It's got brand equity. It's been around since 1896, so it has history on its side. Second, it often works by accident. Because its 30 members are these giant, established blue-chip companies, the Dow tends to move in the same general direction as the real market, even if its internal math is all wrong. And finally, it's just better for TV. The Dow is up 200 points. Sounds a lot more dramatic and exciting than the S&P 500 is up 0.4%.
So, what's the big takeaway from all this? I think this quote just nails it. In the Dow, a $1 move in United Health is 3 times more important than a $1 move in Apple. If that doesn't strike you as structurally, fundamentally absurd, then you might just be the exact kind of person Charles Dow was looking for way back in 1896.